having said that then, because that's our approach, I'd have to say that I'm not especially an optimist necessarily, but I'm also not a pessimist either one. I like to think I'm kind of a realist. And so the information I give to you today is from that perspective. But we are 3.5 years now following the financial market collapse that caused so much disruption in the world that I work in. Technically, the recession ended in June of 2009. And by historic standards, we should be seeing something well into a very, very strong recovery, both in GDP or economic growth as well as employment as well. Yet, many of the economists that actually have been doing their analysis, particularly of last year, continue to refer to the state of the economy as being just a little bit above stall speed. Now, we just got the report that the fourth quarter GDP number, the economic growth number, was up 2.8%, so it definitely was building some steam through the course of the year. But they also give the average for the entire year at about 1.7%. Now, that's an advanced number. They'll come back. They'll do 2 more revisions on that. But any way you look at either one of those numbers, still, at this stage of the game, that's below trend. I mean, you can go back and look at 65 years of history, average it all out, and you get to about a 3.28% average growth rate. So even after having the opportunity to boy from a very, very deep recession, we're still operating below trend. Unemployment, obviously a number hits the news all the time. Clearly, private sector has started to create some new jobs, and that's a positive thing. Government tends to be pulling back on their hiring. I think that's necessarily to be expected. For all of last year, the average number of jobs that were created on a net basis, though, was about 125,000 jobs per month. That number is pretty much just about what's needed if you're going to hold the unemployment rate even. Now, in many respects, that's kind of obviously not fast enough to be able to do a whole lot to the unemployment rate. Having said that, at least it's fast enough now that maybe people aren't nearly as afraid about losing their job as they might have been a couple of years ago. We think, though, from a business perspective, a planning perspective, it's important to understand some of the backwater associated with the economic numbers. And as a result of that, I'd like to check in with you today in what I believe are some uncharted waters. If you look at housing, for instance, it does appear that we're maybe approaching the bottom of the housing market, or at least a plateau at least. But we still have 20% of the homes that are sold today are coming out of foreclosure. And housing contributed almost nothing last year to our GDP numbers. Obviously, the big wild card in the economy right now is Europe. Europe appears to be moving back into a recession. They had some negative numbers that were reported today. And they are facing the potential of their monetary union over there, which is 20 years old, starting to unravel, as some of those countries over there actually start to see the marketplace's response to the fact that they've been spending too much money and running too large of budget deficits. So one has to actually ask the question at this stage of the game, if that's where GDP is, if that's where employment is, if that's where housing is, if that's what's going on in Europe, are we in some kind of a really, really long economic cycle here, or is there some kind of fundamental structural change going on? Because, and this is a big because, those relatively weak numbers are all being posted on the backs of a Federal Reserve that has an extremely loose monetary policy, 0% overnight bank rates, as well as having just tripled the size of their balance sheet, which is another way of saying printing money, buying bonds, and injecting that cash into the economy. So again, it looks to us like there are some interesting things going on, conditions that exist that, quite frankly, are unfamiliar to us over time. I mean, if you look at some of the things that have happened recently that are fairly unusual, for the first time ever, Standard & Poor's actually downgraded the credit rating of the United States of America. They've hinted they might do it again. Moody's Investor Services has hinted they might be moving in that direction as well. I find it fascinating that at the end of January this year, the Federal Reserve actually came out and redefined what they consider to be full employment. And the reason I say that is because always, at least back when I was in college, full employment was considered to be about 5% unemployment rate. And that's because people change jobs, they move, there's just a natural turnover that occurs. And the Federal Reserve came out and said, well, we're going to move that number up to about 6.5%. And I don't know if that means they're just throwing in the towel, or if that means there really is some structural change going on here that's going to affect that over the long term, from a long-term perspective. The labor participation rate, lowest it's been in 29 years at 63.7%. Probably the most significant thing, though, that we like to watch is not necessarily the unemployment rate per se, but the underemployment rate. The Labor Department publishes what they call U2, which is the unemployment rate, that's the 8.3%. But they also publish a U6 number, which includes not only those folks that are unemployed, but also the people that are working on a shortened work week, or the attorneys that are working on McDonald's, or people that are not quite fully employed the way they want to be, and that number is over 15%. And probably just as disturbing in all of that is the fact that for the people that are on unemployment insurance right now, if you've been, that are on unemployment insurance, about 42 to 45% of the folks that are there right now have been so for more than 26 weeks. So there's a duration that seems to be moving out, and as I'm sure you're aware, the longer that you're unemployed, the more difficult it is to find a job. Having said all that, one of the other major significant elements that's occurring now that we haven't dealt with for a long time is the fact that the federal debt, the amount of Treasury securities that had to be issued to fund our deficits, now equals 100% of our GDP. That's the highest level it's been since the end of World War II. It was that way at the end of World War II for obvious reasons. International Monetary Fund estimates that by 2016, that'll be 115%. I mean, we're creeping our way towards Greaseland, if you will. But that's important because that tends to drain resources from the economy. It obviously is a concern to the rating agencies. It creates some business uncertainty, and it also ultimately has an impact on economic growth going forward. And as we all know, we've made some more commitments from the federal government that we're not able to fund right now. Digging down a little bit deeper into some unusual events, for instance, in the housing market, and I know housing is a regional thing, but prices broadly across the country are down about 33%. The mortgage rates are at the lowest people have seen for years. You can get a 15-year Fannie Mae, Freddie Mac mortgage today for 3.5%, which means affordability is obviously at the best it's been in years. So it's obviously not an interest rate problem, yet we still see fairly lethargic sales. In fact, 2011, from a new home sales perspective, was the worst year that they posted since they actually started tracking those numbers. Today there are 2.2 million houses that are actually sitting vacant. Morgan Stanley has estimated there's about 2 million houses that are in foreclosure now. They further estimate that about 7.5 million homes are ready to go into foreclosure at some point. You take states like Nevada, 80% of the houses in the state of Nevada are underwater on their mortgage. Their home just simply isn't worth what the mortgage is. So if affordability is so good, how come people aren't buying right now? And again, back to Greece for just a moment. They're negotiating a write-down of their notes that are held by private investors, which is another way of saying the banks over in Europe and to some degree here. They're also going to need help from the European Central Bank, from the International Monetary Fund as well, in order to meet their obligations. March 20th is a big date for them because they have an $18.5 billion bond that's due at that point in time. But I think it's important to recognize whether Greece negotiates a write-down of their loans, their debt, with the banks that hold that debt, or whether they just don't pay their bills. Any way you look at it, that's a default. And that's not something that is unheard of, but it's something that was not expected from countries that have come together to form the economic union in Europe. It was interesting also, I'm sure you saw on the news earlier this week, that the legislature in Greece adopted some new austerity measures to try to cut back on their budget methods, and the citizens celebrated that with great glee by burning down many of the buildings over there and rioting in the streets as well. But the European situation is an interesting one, and it's difficult to work out for a couple of reasons. Number one, you've got all of these 17 countries that have come together to have one monetary policy, much like what our Federal Reserve has here, but yet each one of them gets to set their own fiscal policy, which means their own tax policy, their own government spending policies, and they're not all doing the same thing. It's further constrained by the fact that they all have a different interest in their involvement in the euro as a currency. If you're Germany, you want to do everything you can to hold that currency together, because the value of a euro today is cheaper than if you still had the German currency, the Deutsche Mark. The fact that there's these other countries in the whole euro currency brings down that valuation, which means they have cheap money. They can sell, they can export, particularly within the ECB, but also around the country as well. If you're somebody like Greece, we know that typically the way countries have paid off debt that they couldn't afford was to devalue their money, just pay it off with cheaper currency. But Greece is part of that euro currency. Greece knows that their euro is being held at a higher value than if they still had the old drachma. And the only way they can see that without a bailout they can pay off those loans would be to devalue the currency, but they can't do it because they're all part of the euro. And that's some of the conflict that's going on over there. That's why it's not going to be resolved anytime soon. Also, highly unusual times from a Federal Reserve perspective. For 3 years now, we've had the Federal Reserve set short-term rates at almost zero for all practical purposes. And again, they've tripled the size of their balance sheet through their quantitative easing. Their quantitative easing is another way of saying printing money and then taking that money, buying bonds into the marketplace in an effort to hold down interest rates, but also push money into the marketplace. To the extent that you can buy a 10-year Treasury bond today for your investment portfolio that will pay 1.9%. So if inflation is about 3%, you're earning a negative yield of 1.1%. And people are doing that, investors are doing that every day. Well, the Fed's saying they're doing that because they want to reflate the housing market and they're concerned about employment. But I got to tell you, that's truly an unprecedented move. Taking that one step further, the Fed surprised us all last fall when they actually came out and publicly said, we're not going to raise interest rates for at least another 2 years. Now, think back in the days of Alan Greenspan when he used to testify before Congress, and people made a living out of trying to figure out just what exactly that guy said. Because he worked very, very hard at speaking without saying anything. And now we've gone a complete 180 to where the Fed now comes out and says, we're just going to tell you we're not raising rates for 2 years, which is kind of another way of them telling you the economy stinks, it's going to stink for a while further. They took that one step further at the end of January when they actually released their first publicly printed forecast, where the Fed actually said on a quarterly basis now, we're going to go out and tell people where we think interest rates are going to go. And in doing so, they even took it further and said, not only are we not going to raise rates for another 2 years, we're not going to raise rates for almost close to 3 years. So, highly unusual conditions, uncharted waters for us, almost 6 years of zero interest rate policy when it's all said and done. I have my own kind of cynical view on this, by the way, and this is not something you'll read in the trade press. I have another reason why I think the Fed won't raise rates besides housing and employment. I think it's because our government can't afford to pay higher interest rates. You know, if you raise the Treasury interest rate by 1%, that adds $150 billion a year to our budget deficit. Our budget can't handle that in this country. It can't handle it in Europe for that matter, Japan for that matter. I have another reason why I think they've been so aggressive on quantitative easing or printing money, and that is because we used to make Treasury bills, bonds, and notes available, and they were purchased to a large degree by the Japanese, by the Chinese, to some degree by the Russians. Those people are fed up. They've had enough. They don't want to buy anymore, so the Fed's actually having to do this, so there's somebody to buy this stuff. Well, kind of where does all this bring us then? It brings us to the fact that we're operating in some uncharted waters here. None of the typical, and I shouldn't say none, but many of the typical economic formulas or practices or understandings that used to apply seem to not work so well in this environment where we've had all these unusual things that are happening. So I go back to the question, are we in a long, long cycle, or are we in a fundamental structural change? We think we're in a fundamental structural change, which means we have to define for ourselves what all this means on a going forward basis. It means the policymakers are likely going to have to come up with different tools than they've used in the past, and it means organizations like us, for our own bond market activity, have to have a better understanding of how we think those things influence how the market's going to accept our securities in the future. And it also means you need to take a look at that when you make your own investment decisions. The old rules of the game in these uncharted waters don't seem to be working right now. Stay tuned, more to come. Great to see you. Thanks for having me here. I appreciate it.